Canada stands at a critical crossroads in its energy sector, caught between external pressures and internal political choices. With Trump already back in office and signaling a more aggressive stance on trade, Canada's heavy reliance on the U.S. as its primary energy export market is under heightened scrutiny. The renewed political uncertainty underscores the risk of overdependence on a single partner, especially one willing to disrupt long-standing agreements. At the same time, upcoming Canadian federal elections have brought climate policy and energy independence to the forefront of political debates in the country, which faces urgent decisions about energy infrastructure, whether to invest in pipelines and oil sands expansion or accelerate the transition to renewables and interprovincial energy grids. The choices made now will shape not only Canada's energy independence, but also its ability to withstand geopolitical shocks and uphold its climate commitments. To discuss these matters, I'm joined by Eric Nuttall, partner and senior portfolio manager at NinePoint, a Canadian investment firm. Eric, thank you for making the time and joining me on the show. Trump's threats to place tariffs on Canadian oil, is it really realistic given that some 60% of U.S. oil imports come from Canada?
That's right, and I'm happy to spend the time with you. It's long been our assertion that tariffs would not be applied on Canadian energy, be that natural gas or oil, for the reasons that you point out. We have a mutually necessary relationship. The Gulf Coast primarily and other parts of the United States imports in a massive amount of Canadian oil with very little substitutions. We produce a heavy grade, which the refiners are geared to produce into gasoline and diesel. When we look at key critical areas of the United States, such as PADD 2, so the Chicago area, they import in 3 million barrels per day of Canadian heavy directly via pipelines. And so there's no substitution. You cannot barge, you cannot truck 3 million barrels per day. And any tariff on that product would be massively inflationary. By our math, a 10% tariff would equate to about a 16 to 17 cent direct per gallon direct pass-through to the U.S. consumer. And so there's very little rationale and logic. I'm the first to admit that with much of the tariff policies that we've seen, perhaps logic and rationale are not necessarily being used in that conversation. But for a product that is in critical need and of little substitute, and especially at a time when U.S. production growth we think is starting to stall, there's very little reason to see that tariffs will be applied on Canadian oil.
But Eric, what can Canada do to shield itself from being threatened this way again from its southern neighbor? What are some of the strategic options for Canadian energy at this juncture in terms of energy infrastructure and alternative export routes?
Yeah, it's a new reality for Canada, I think. We never thought that we would be betrayed or threatened to this degree. The United States has always benefited from a safe, reliable, and cheap source of crude. As they've had the power of the negotiation, it's resulted in wide differentials for our product. Thankfully, we've been building out incremental takeaway capacity to access our West Coast, to diversify our customer base. Still, though, about 94% of our oil is being shipped to the United States. And so there's a critical necessity to increase export capacity to send our oil to Asia. There is a potential expansion of about 300,000 to 400,000 barrels per day that we could add, I think, in relatively short time. It just comes down to the willingness and desire of whatever government will be electing in the coming weeks to make it an urgent national priority, because truly the energy abundance that Canada has could be our trump card. If we had greater export capacity, customer diversification, and not the reliance on the United States to purchase and refine our oil, I think it would put our country in a much, much stronger negotiating power, not just for energy, but for all commodities and all goods and all services when it comes down to tariffs. And so we're still a couple years away. Another initiative would be building a pipeline capacity to the East Coast to access different markets. That's a little trickier because there are issues with certain provinces that have typically been anti-oil, anti-energy. We've seen a softening, thankfully, on the part of their leadership. And so perhaps it would just take a special, relationship, ensuring that there's something in it for them to be able to gain pathway through that province. But at least there's a national conversation now being had. And at a time when a minority of the population supported the energy sector, now 80% of Canadians agree in the strategic necessity to build out more pipelines. So it's been a real shift in mindset, 100% courtesy of being threatened to the degree by President Trump in the United States.
Well, Eric, you've mentioned Canada's next federal election, which falls on April 28th. How important is this topic in the election cycle, and what are the different stances you see coming from the main party leaders at this point?
Yeah, it's a critical moment, I think, for our country. We've had a government for the past 10 years that has not been entirely supportive of our sector. They've put into legislation such as a carbon tax. So we're one of the only jurisdictions on the planet that charges a carbon tax on our oil producers. We've put in legislation that's put such onerous burdens on building major infrastructure projects, be it energy, be it other commodities and sectors, that it basically makes it impossible now for a new pipeline or a new oil sands project or a new energy project of any kind to be built. They have to do crazy things like doing gender-based analysis on pipelines and just such nebulous rules, and nobody even understands it. And the upfront costs, the initial costs are so huge that a company could spend $500 million just to get to a point to know whether a project would be approved or not approved. We also have an emissions cap being put on our oil sector, which is effectively a production cap. It means that production levels will have to fall in the coming years. And so it's been this accumulation of policies that have made it very, very hard for our sector to flourish. So there's two primary candidates. One is Pierre Poilievre of the Conservative Party, so more right-leaning, very, very supportive. He's vowed to scrap all of those different initiatives that I just spoke about. He's very, very pro-energy. He's essentially the dream candidate for the energy sector. He recognizes just how important it is to the Canadian economy. And then you have Mark Carney, the former U.S. or UN climate envoy, a gentleman who tried to get financial companies from around the world to stop financing and investing in oil companies. He's an eco-zealot striving for 1.5 degree, which would require emissions caps and lower oil production at a time when the demand for oil, albeit the growth rates are probably slowing, but it basically, I think he would be more of the same of the past 10 years of policies that have allowed Canada to willingly cede market share to other oil producers at the detriment of our citizens.
Mm-hmm. Well, putting the Canadian political situation aside now and moving to the United States, in some of your recent analysis, you've mentioned that we are at a point where we might be witnessing the U.S. shale twilight. So why is that? What are the signs you see there? And if there is a deceleration in U.S. shale, how fast is it taking place?
Yeah, this is a critical theme because it has so many different read-throughs, both for U.S. policy, the future power of OPEC, the ability to satisfy future demand growth. So we believe that U.S. shale is very clearly in its twilight, meaning the best years are clearly behind us. We were already there before the recent price collapse. In 2024, U.S. shale grew by its slowest pace since its inception, if you exclude the COVID times. And so some people may think that that is as a result of government policies, the lack of drilling permits and land. We completely disagree with that. What we see is Mother Nature is now the gating factor to the ability of U.S. shale to grow. What we can very clearly see are wells in all of the three major basins are getting less productive. They're getting gassier, so gas cuts from oil wells are rising. Companies are having to really push the envelope in terms of trying to maintain production, decline rates are rising, et cetera. And so coming into 2025, I would say consensus was for growth of about 150 to 200,000 barrels per day of black oil growth at a time when demand was expected to grow by about 1.2 to 1.3 million barrels per day. And if we reflect on the past 10 years, why is the twilight of U.S. shale so important? Over the past decade, non-OPEC production has grown by roughly 5 million barrels per day. U.S. shale over that same time frame, which is a component of non-OPEC supply growth, grew by 6. And so were it not for the rise of U.S. shale, we would have been in a massive supply deficit, and that is where we're going in the years ahead. Now, we've had the price of oil collapse now to roughly $60 WTI. We are in the death zone for U.S. shale supply growth. It's like a mountain climber on Everest, and you get too high, and if you stay there, you die. That is now where we are for U.S. shale. We think that companies will be dropping rigs. Just last week, we had the rig count fall by the fastest pace in about 4 years. And so we see that trend continuing, and the expectations of growth this year will be declines. To your question, how much and how quickly, we would think on an exit to exit, so the end of this year relative to the beginning. We think at the current oil price, U.S. shale production could fall by 500,000 barrels per day. And at $50 oil, it could fall by 1 million barrels per day. And so if we're in a market today where the balancing factor has to be destroying short cycle supply growth, and that seems to be the environment that we're in, it's going to be U.S. shale because they are the highest cost, the highest decline, the most capital intensive production on the planet. And we are now at the point where we're going to be losing barrels.
So Eric, in comparison, how are Canadian oil sand companies faring versus U.S. shale companies from an investment proposition?
Yeah, so the old perception, the antiquated perception would have been that Canadian oil sand companies are the high cost producer. That is no longer the case. The sector has spent the past 10 years or 15 years even reducing their cost structure. So cash flow break-evens are measured in the 30s. When we look at the required oil price to generate enough cash flow to keep production flat and also sustain current dividends, which are anywhere from 4 to 6%, we estimate the average company needs about $51 WTI to be able to achieve that. And so oil sands will be one of the last men standing from an oil supply perspective. They've spent the past 3 years post-COVID deleveraging. Balance sheets are in incredible shape. Some of our holdings have no cash. They have no debt, rather. They literally have cash in the balance sheets. Other, even at a $50 oil price, maybe they have 1 turn of debt, so 1 times debt relative to their cash flow. So balance sheets are very strong. Business models are very strong. The commitment to weather this storm is very, very strong. Their ability to do so is. And so the contrast between U.S. shale, high decline, high cost, needing a high oil price, relative to the current oil price, we think the oil sands really shines. And from an investment perspective, very clearly it's been a volatile year. Many names are down 20 to 30% from their recent highs. We see the ability to buy decades worth of stay flat inventory that does not erode in quality over time. The average oil sand company would have anywhere from 30 to 50 years of stay flat inventory. And we contrast that to 2 to 4, maybe 5 years for most U.S. shale names. So it's this desire to use free cash flow, buy back shares, with most returning that free cash flow back to investors, where we think, given the sell-off in the stocks, relative to what we think is a more appropriate mid-cycle oil price, which is $70 to $80 Brent, I think we're getting several decades worth of that stay flat inventory, i.e. free cash flow, for nothing today. And so we're quite bullish in the outlook for Canadian oil stocks, energy stocks at large, even though in the short term, it's very difficult to be bullish on the outlook for oil.
Well, let's shift our attention more towards the oil market and OPEC Plus. You know, the OPEC Plus V8 decision to increase production in May 3 times what was originally planned was set to be directed as, pressuring non-compliant members. Given the unfolding price route thus far, will it be enough, you think, to accomplish this goal? And how much time would this potentially need? Would more pain, more sweating be needed?
Yeah, it's definitely a debate now in terms of what was the motivating factor behind the voluntary members of that deal to accelerate the return of those barrels, because there's some similar parallels between now and 2020. In March 8th, 2020, key leadership of Saudi Arabia decided to surge their production at a time when we had maximum uncertainty on the demand outlook due to COVID. Today, I would say it's similar narrative. While demand growth is hanging in so far, it seems likely and realistic that we're going to see a sharp slowdown if President Trump goes ahead fully with the announced tariffs. And so to accelerate the return of barrels into that environment is confusing. I think the rationale behind the certain decision makers' thinking is similar again back in 2020. It's intended to force behavior. It's intended to force compliance. Today, it's the form of several actors who are not holding up their end of the deal. We think that the leadership of Saudi Arabia adheres to their word. Their word is their bond, and you've seen that in very, very strong compliance. And yet certain countries like an Iraq or a Kazakhstan continue to thumb their nose and continue to cheat by several 100,000 barrels per day. It was announced that in March, I think Kazakhstan and Iraq were overproducing by about 400,000 to 500,000 barrels per day, and so collectively, so very, very strong. And so I'm hopeful, although I'm not overly optimistic in terms of a significant improvement in compliance. And I would not rule out further expedition of the return of those barrels. I think this narrative, especially within Saudi Arabia, about fiscal break-evens in the 90s, $90 Brent, and their weakness in that environment, I don't think that is valid. And I think that the ability to weather the current weakness is a show of strength, in fact, to other countries to try to improve that compliance. And so whether it's a sweating, I call it a Kazakh spanking, I'm hopeful that we'll see improved behavior, although in the short term, I'm not overly optimistic on that.
Eric, could the OPEC plus V8 decision be considered as one stone targeting a few birds at the same time, such as appeasing Trump, limiting non-OPEC plus future supply growth, and or protecting market share, in addition to what we just discussed about pressuring the non-compliant members?
It could be viewed on that, and I'm the first to admit that the timing is very suspicious. It was announced the very next day after Liberation Day. So President Trump announces all of these tariffs, some of which have been watered down, but ignore that. And so it feels to me like the timing was purposeful to try to exert maximum pressure on, again, those who are not compliant. It does reinforce this narrative that the White House is pressuring key OPEC members to add barrels. It's our understanding that there's not necessarily validity to that narrative, but that is a narrative that's been driving the oil price, because President Trump has been very explicit in his desire for low and lower oil prices as a way to fight the inflationary impact of tariffs. And so in the end, though, what we think the action is meant to improve compliance. It's our understanding that it's not necessarily coming from pressure from the White House, and instead there's a very specific desire to improve compliance and get back to a deal's a deal, and for everybody to honor their word.
Finally, Eric, on the energy transition, the narrative seems to be shifting lately, given the rising relevance, once again, of energy security, affordability, and rising demand, particularly from AI and data centers. So this brings back the notion that what is actually happening in energy is not a transition, but rather an addition, as it was always historically, and that it is in no way plausible that a full transition to renewables can actually be realistic in the coming decades. What are your thoughts on that?
I could not agree more with what you just said. There is no energy transition. There's no energy transition when the demand for oil, natural gas, coal, and even wood as an energy source hit all-time highs last year. And I think the election of Trump allowed a reset in conversations more in the Western hemisphere than Eastern and Middle Eastern hemispheres, where I find our ministers, our government officials have been very, very energy ignorant. It's always refreshing to travel to your area of the world and meet with officials who get it. They understand that at a time when the world's population is going to grow by 25% between now and 2050, it's occurring in areas of the world, not in the United States, not in Canada, where our oil demand has been relatively flat for the past decade, but instead in areas where demand is actually growing meaningfully, where energy intensity, much of the world consumes 3 barrels of oil per person per year versus a 13 to 14 in the Western Hemisphere. We have urbanization. And so to this view that we're reaching peak demand for be it oil or natural gas or energy at large has been rooted in just such profound ignorance. And when you look at the new sources of power demand in the United States, where power demand increased in 2024 for the first time in about 15 years, it requires 24/7 non-interruptible power for data centers. And so what happens when the sun doesn't shine, the wind doesn't blow, and battery technology is not adequate or possible to provide that energy? Well, now the conversation is all around natural gas and nuclear. And so natural gas has gone from the bridge fuel, supposed to bridge us to somewhere in the future, to now is the fuel. And so it's been a radical change both in North America and I think globally in terms of the perspectives that renewables have. Yes, they have a role, like such as Saudi Arabia. I believe by 2030, half of their power will be coming from renewables. Yeah. Now, at the same time, that will also prevent them from burning oil for power generation, allow them to export. So there is also an economic case in addition to wanting to meet emission reduction targets. But I think now we're having just a much more realistic conversation all over the world in terms of the importance of non-energy ignorant based decision making. Countries like Germany, which just blew up, their last coal plants and even their last nuclear reactor. Well, energy prices surge, unemployment goes up massively, industry leaves because energy and power prices are too high, and eventually the electorate will vote them out of office. And so I think that's a warning sign to politicians in other areas of the world where they've got to be a lot more pragmatic in terms of if we're approaching, some goals for net zero by 2050 or 2100 or whatever the time frame will be, even if that's even possible. It's just the demand for traditional energy, whether it's oil, whether it's natural gas, whether it's even coal, that runway for demand is much, much longer and much, much stronger than what most people would have thought a few years ago.
Eric Nuttall from NinePoint, it's been a pleasure having you on the show. Thank you very much.
My pleasure. Thank you for having me.